Welcome to the Gorman Trubitt Not-for-Profit Insights Webinar Series. Like many others, due to the COVID-19 concerns, our NFP live events for 2020 have been canceled. As you have come to rely on our CPE-eligible educational training for not-for-profit specific CPE provided throughout the year, we have decided to shift our not-for-profit events into a virtual webinar format called the Not-for-Profit Insights Webinar Series. Your not-for-profit finances during a crisis can be stressful. LGT with invited guest speakers from Polsinelli will help you understand where you are now and where you need to be. In this Zoom webinar, we will introduce you to the changes in your forgiveness from the PPP Loans Flexibility Act and the importance of endowments, restricted gifts, and the Uniform Prudent Management of Institutional Funds Act when planning for a crisis. It was recorded live as a Zoom webinar on July 22nd, 2020, and all information was accurate and up to date at that time. If you have any questions regarding this webinar or future not-for-profit webinars, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
Hi, everyone. This is Jonathan Blum. I'm an attorney at Polsinelli with a focus on nonprofit organizations. I'm here to present the next segment of this session on endowments, restricted gifts, and UPMIFA. There we go. Nice to see everybody, sort of. In this strange universe that we're living in, we get to look back briefly and say 2019 was a great year. 2019 giving reached nearly 450 billion. Increases in most sectors were appreciated and based on the various giving trends. And into the first bit of 2020, this trend was continuing. And then we had this little thing called COVID-19 that interfered with all the great work all of us were doing. The Nonprofit Times reported that fundraising declined 6% in the first quarter. March alone showed a decline of 11% year-to-year comparison. So we recognize that there was a significant effect, not only from the obvious of canceling events, but from the various implications of COVID-19. Our ability to fundraise as organizations showed significant decline. Nonprofits began remote fundraising initiatives in order to try and replace the revenue that was lost from the various activities that were unable to be continued. The Chronicle of Philanthropy had some dire warnings for the sector. They recently reported that there's concern that 22,000 nonprofits will fail due to coronavirus. And that is assuming that this current economic downturn as a result of COVID-19 could last up to 24 months. And that's just an estimate. So that leads to many questions about how organizations can continue to survive. Obviously, the word pivoting and the new normal has become consistent. And I've had many questions from various organizations reaching out to me to say, we have all these restricted gifts. So we have cash essentially on the balance sheet, but we don't necessarily know how we can use them. And so let's take a look at restricted gifts just so we're understanding what we're talking about when we're talking about restricted gifts. So restricted gifts are donor-directed gifts that are restricted as to either duration, meaning the timeline that the organization has to spend or utilize the funds. With respect to spending, there could be limits on the amount spent, or it could be intended to be held perpetually, like a perpetual endowment. There are also restrictions that could be with respect to the use. General unrestricted funds are obviously what every organization wishes to have the most of. Next would be large buckets of categories like educational purposes, or the donor could be even more specific. That specific program with a specific title, with a specific duration. In addition, donors could have a mixture of all those restrictions. And one of the concerns with restricted gifts, and the reason why most organizations prefer unrestricted gifts, is that they're completely fungible. You could utilize them wherever they're needed most within the organization. And in these unusual times, restricted gifts are problematic in that many of the ordinary course opportunities for delivering services may not be delivered in the same way. And so how do we access those restricted gifts? But before we get to how to access them, let's look at some issues with restricted gifts. Obviously, we've got the concern now that ordinary course activity is not happening. Ordinary course activity isn't happening. And so if you're accepting restricted gifts, there's always the concern of mission creep, that it's beyond your existing charitable purpose, that the scope might be too narrow. And the scope yesterday versus the scope today, still inability to comply is a difficult concern. And there could be operational consequences. If there are restrictions with respect to those dollars, are there other dollars that need to be applied in order to effectively meet those purposes? So it's important, as you're thinking about this change and as this shift has occurred, when you look to your gift acceptance policy, and if you don't have a provision in your gift acceptance policy that talks about what kind of restrictions are acceptable to the organization, now would be a good time to examine it. Because at the end of the day, is the pain of those restrictions worth the gift itself? So when we talk about restrictions on gifts, we necessarily implicate what's called UPMIFA, which is called the Uniform Prudent Management of Institutional Funds Act, which is a mouthful. But it's a uniform act that has been implemented in 49 states and the District of Columbia, including Texas. Under Texas, it's codified under Chapter 163 of the Texas Property Code. And it provides for prudent standards for investment and management of charitable funds. And that includes restricted gifts to nonprofit organizations. It's helpful if, in the event the gift instrument is silent or vague and needs interpretation. UPMIFA was intended to provide codification of what was typically used as just common law standards or interpretation by the various attorneys general in their enforcement of charitable trusts. So now the statute governs restricted funds and endowments held by charitable organizations. One important thing to note, and this is critical in this exact moment, the way that the statute is implemented in terms of enforcement is that compliance with the statute is viewed at the time of the decision, when the organization makes the decision, and not in hindsight. This is critically important because it's very difficult to know what's going to happen in our current circumstance in a year or in 2 years, when there might be an opportunity to look back and say, in July of 2020, what were you thinking? Because now we know in hindsight it's different. The important aspect of this is that compliance will be viewed at the time the decision was made, which is right now when you're taking that decision and not with some future look back. So when you're looking to remove restrictions, UPMIFA gives you some guidance of how you can look at the sequence of events and what the opportunities might be. And when an organization calls me and says, hey, we've got all these restricted funds, we really need to use them for other purposes, what should we do? How should we go about doing it? The first is to look at the donor. Look to the donor and ask the donor to consent to either entirely removing the restrictions, making those funds unrestricted gifts, or to modify the restrictions to amplify the ability of the organization to use the funds in different ways. And if the donor either does not consent or is unavailable to consent, and there's no family that doesn't survive, and there's no family or next of kin that has the ability to consent to a change, then you might have to look to other steps, which could mean a court process. And UPMIFA outlines the basic requirements for the court process and suggests that if you are trying to modify the restrictions on management or investment of the restricted funds, you can look to see if it's impracticable or wasteful. You can also look to modify the use of those funds, restrictions on the use of those funds, if it's unlawful, impractical, impossible, or wasteful. And this historically was called Cypre, which is originally a I believe, a French term that's intended to mean applied to the closest way that you can. So meaning you're attempting to reinforce the meaning of the donor gift, but because of circumstances that came up, that you need to modify the ability to use those funds. Helpfully, MIFA also provides an opportunity for old and cold funds to be utilized. So if there's a fund that holds less than $25,000 and has been in existence for 20 years or more, then you have the opportunity to remove the restriction and use those funds, because they basically set a threshold and said that's basically demonstrating that it's impracticable or wasteful if it's been that cold and that old. Next, we move on to endowments. So if there's pressure on an organization to look at their restricted funds because of their economic situation, they might also be looking to their endowments. And organizations should exercise caution in the event that you're facing public pressure to use your endowed funds. The difficult explanation to third parties or to even individuals associated with your organization is to recognize that you have cash, but those cash assets are not for any purpose whatsoever. They're restricted, and endowments are restricted funds. They were given by the donor and restricted for a particular duration. So that duration could be a particular time frame, or it could be intended to be perpetual. We should be careful about the understanding of what an endowment is. In many cases, boards tend to misuse the term endowment and misunderstand its application. To the extent funds were restricted for a particular duration, as in perpetual, by the board and not by a donor, then that is not treated as an endowment under MIFA. Importantly, the board that created that restriction is the same group or body that can remove that restriction. So we have to be careful in our understanding of what is a true endowment versus what in many cases is called a quasi-endowment. But to the extent it's a donor restriction or a donor limitation as to purpose or duration, those have to be respected. So even if you're able to extract funds from an endowment with respect to its duration, the purpose of the gift, in other words, the use of those funds, is still subject to the restriction that the donor imposed on it. So MIFA governs the investment and management of endowments, and it applies what's called a prudent investor standard. And it has several relevant factors. Here are just a few of them. It lists factors that should be considered in extracting funds from an endowment. It includes general economic conditions, the needs of the organization, other resources available to the organization, investment policy, and the purposes for which the fund was created. If it was intended to serve a perpetual purpose, then that is obviously important in the interpretation of how to implement a MIFA and how to dictate expenditures from the endowment. So if an organization is looking to invade its endowment or expend funds from the endowment, the qualifications under a MIFA are requiring prudent expenditures, looking at the total circumstances of the organization. If you have an investment policy, which hopefully you do, you would look to that investment policy. If you have a spending policy that discusses when assets should be spent from an endowment, that policy should be reviewed. And there's a standard within a MIFA that basically states that spending greater than 7% of the fair market value of the endowment, if it's 1 million or more. If it's less than 1 million, or if it's less than 1 million, it's actually 5%. Spending greater than 7% or more has a presumption of imprudence, meaning it's presumed that it's an inappropriate expenditure, unless the organization can demonstrate and overcome the presumption of imprudence that expenditures in excess of 7% are justifiable, and consistent with the requirements under a MIFA. Just like other restricted funds, you can ask the donors to review these restrictions and lift them, whether it's to use or duration. So if a donor is able to come in and say, I agree that we should remove the restriction on these endowments because of the circumstances of this organization, and I think those funds would be used appropriately that way. If the restrictions can't be removed and 7% is insufficient, and the organization is concerned about overcoming the presumption of imprudence, then you could exercise the opportunity to remove the restrictions using cypre, as we discussed, going to a court, and possibly seeking the approval of the Attorney General in order to do that. Any court proceedings that reference a charitable trust have to notify the Texas Attorney General, and they have the opportunity to intervene in the case. Similarly, I get lots of questions about whether you can borrow against an endowment. And the answer to that is generally no. That endowed assets are not meant to be used as collateral or not meant to be used as a fund for borrowing, especially if it's being borrowed for a purpose that is contrary to the donor restrictions. And use as collateral is really just a future potential use of the endowment. And so if it's used for purposes to collateralize a loan that's for purposes beyond the restriction, you could have problems when that collateral is exercised, when the lender exercises against the endowment. And then at that point, when that use is taken, that it would be inconsistent with donor restrictions and inconsistent with MIFA. And so generally, it's against MIFA to borrow it against an endowment. Now, other issues that have come up recently with respect to endowed or long-term restrictions by donors is naming rights with respect to buildings or other naming rights. So for example, recently, Berkeley School of Law had the name Bolt School of Law on its buildings, and it's used frequently to describe the law school itself. And the dean of the law school agreed to remove the name due to a donor's racist past. That's been a trend among organizations and institutions even before the most recent discussions about racial equity and racial justice. And in this case, what is interesting is that Bolt wasn't a donor. The name attached to the building was out of respect for his overall contribution to the school itself and not as a donor restriction. So the ability to remove it was easier. In another case, the Tennessee division of the UDC versus Vanderbilt University tried to remove Confederacy from the name of a building. In this case, the Court of Appeals held that the donation was a charitable gift and that the only remedy for the organization to remove the name would be to return the present value of the gift back to the donor. Well, the original gift was for $50,000 in 1913. If you did the math, the present value of that gift was $1.2 million to enable the university to remove the name. In the matter of Paul Smith's College, this university was struggling from a financial perspective and was offered $20 million in order to sustain the organization as a general gift, but the contingency for the donor was that they renamed the school after the donor. Paul Smith's College recognized that this was a lifeline and sought to get a cypre order from the New York Supreme Court to release the original naming rights so it could receive the needed funding. The court denied the order because the original naming rights gift had not become impractical or impossible to be carried out. And in spite of the dire financial circumstances of the school, those were not the qualifications that were required in order to remove the restriction on the gift. Another example recently in New York, the Lincoln Center for Performing Arts The Lincoln Center settled with the family of the original naming rights of one of the major buildings, one of the music halls, by returning $15 million of the original gift. And instead, it was a gift by Geffen, I believe, who wanted to provide $100 million in order to rename that building. So the organization decided that giving up $15 million in order to settle with the original family who provided the naming gift was worth in exchange for $100 million at a later time. So all of these circumstances come into the idea that naming rights are something to be thought about very extensively on the front end. If you treat naming rights just like you would any restricted gift, especially those that are granted in perpetuity. Perpetuity is a very long time. And so there are many circumstances you should think about in terms of what are you as an organization willing to accept with respect to that naming right. There are considerations that should be had. For example, some courts, such as in the Vanderbilt case, tied the naming rights to the life of the building. In other cases, if the building is destroyed, do the naming rights have to be renewed? The naming rights could be for a certain period of years instead of actual perpetual naming. And if the organization moves buildings, would that name have to move with it? What would be the restriction or the requirement? Or if the building is sold, what happens to the naming rights at that point? In addition, with the discussions around the opioid crisis, gifts from the Sackler family, for example, have led to unnaming of various aspects in museums and otherwise. So this has led to a renewed emphasis on retaining unnaming rights or morals clauses under gift agreements. So to the extent that at a future time, a name that at one point was very prestigious falls into disrepute, there is an opportunity for the organization to remove its association with that named individual, regardless of the naming rights associated. And so in all of this, as you can see from the restricted gifts, from the endowments, and from the naming rights, organizations really should review their gift acceptance policy. We have seen in the COVID crisis that organizations are now looking at these restricted gifts as far more of a burden than a benefit, and that if they had been more diligent and deliberate on the front end of explaining the potential implications of restricted gifts and how restricted they actually are in situations that could be completely unanticipated, such as the pandemic, where the organizations across the country have been forced to change the very way they do business, that the restricted gifts again, create more problems than benefits. So it's an opportunity for organizations to re-examine their restricted gifts, their endowments, and their naming right policies, and implement policies and procedures that could be more helpful and constructive in terms of how gift acceptances, gifts are accepted going forward. Thanks, everybody.
Today, I'm going to be talking about the Paycheck Protection Program loan in recent updates. This presentation is geared more towards people that have a general understanding of the PPP loan program. If you're not familiar with this program, on the slide right here, there's a resource page where you can go to and watch prior webinars to get caught up to speed. So before we get started, standard disclosure, this is just educational, for educational purposes. If you have any more specific questions as we go through the presentation, just feel free to reach out. The agenda today, we're going to talk about the Paycheck Protection Program Flexibility Act of 2020. This was signed into law on June 5th. There's some recent SBA and Treasury guidance that has come out. The forgiveness application, there's now 2 applications. There's an easy application that's a lot simpler and easier to fill out. The loan forgiveness process with lenders, and then if we have time, common mistakes and questions that we run into. So before we get started, a little bit about the timeline of how this all has transpired. On March 27th, the president signed the CARES Act, which within this act was the PPP loan program. And then on June 5th, the president signed this Paycheck Protection Program Flexibility Act, which I'm going to talk more about today, which made some changes to the original legislation that was passed. And then on June 16th, the revised loan forgiveness application was released. This was due to, since the president signed a bill that made changes to the original PPP loan program, they had to revise the application. And then also unexpectedly, there was this easy application that was released as well. And then on June 30th, the president signed a bill to extend the application window to August 8th. What that's talking about is originally this loan, to apply for the loan and get the funds, you had until June 30th. But when we're getting closer to the June 30th date, there was still businesses that hadn't applied and there were still funds available. So they decided to sign legislation that would extend the extend the window to apply until August 8th. So if you haven't applied, it's definitely worth consideration. And then there have been some revisions to rules or guidance that have been released. Because if you look up at the top, the CARES Act, which had the PPP loan program, came out on March 27th. Between March 27th and June 5th, there were numerous guidance, and it was almost changing every day, where there's information that came out. They had to go back and revise everything based on what came out on June 5th. And some of these revisions I'll go through as part of my presentation. Okay, so the first thing, this Paycheck Protection Program Flexibility Act of 2020, this was signed on June 5th by the president. What this did is any borrowers who received a loan prior to June 5th now have the option to extend their covered period to 24 weeks instead of 8. And I'll get more into what a covered period is later. It's basically when you receive your loan proceeds, you have a certain amount of time to spend your funds. And some businesses were shut down and whatnot, so they signed this into law that essentially allowed businesses to have 24 weeks. And if you received your loan June 5th or later, you are going to have 24 weeks to use your loan proceeds. What else this bill did was it changed the payroll. The payroll expenditure requirement used to be that you need to spend at least 75% of your loan costs on payroll. It's been reduced to 60% now. And if you don't spend up to 60% of your loan proceeds on payroll costs, what's going to happen is when you go to apply for forgiveness, you're not going to be able to get the full loan forgiven because it's based on how much payroll you expended during the covered period. Okay, there's also when you get your money and you have that certain time frame, which it's called the covered period, to spend your funds. If you spend all your funds, you initially think, okay, I'm going to qualify for full forgiveness and my loan's going to be completely forgiven. Well, within that period, if you reduce your head count or you reduce how much you're paying employees, it's possible you can have a reduction in how much of the loan amount can be forgiven. And there were some safe harbors that if you restored your head count or the wages that you're paying people by June 30th, that you could get out of having any of these reductions. That safe harbor date has now been changed to December 31st or the earlier of. And then there is also a new exception for full-time equivalent reduction. If the borrower is unable to return to the same level of business activity as before February 15th, 2020 due to COVID-19, what that's essentially saying is like you couldn't get your head count back up during your covered period because of COVID-19. And this is a new exception that will allow you, if you are doing the calculations and you do have an FT reduction and you have to use the long form, this potentially could allow you to get out of that reduction and not have a reduction, and then you'd be able to get more of the loan forgiven. Okay, so if you got the loan after June 5th, your payment period is going to be extended to 5 years instead of 2 or 1. I actually can't remember at this time. But if you received your loan before June 5th, you're still tied to the borrowing terms that you agreed to at that time, but you can go back to your lender and ask them if they will be willing to extend the period to 5 years. And this would only be the case if you're actually going to owe money back because you can't get the full loan forgiven. Then towards the bottom, this legislation does not address tax deductibility of expenses paid with a forgiven PPP loan. I know this isn't much of an impact on the not-for-profit world, but the IRS has come out and said the expenses are not deductible because when the loan is forgiven, it is going to be tax-free. So then the underlying expenses cannot be deducted either. Okay, so I went through briefly the changes that occurred on June 5th when the president signed law. There's been some more revisions, and this is actually a big question that comes up. What happens if I choose to use the 24-week covered period, but I use all my funds up before that? Can I apply for forgiveness and not have to wait the full 24 weeks? And the answer is yes. It says right here, a borrower may submit a loan forgiveness application anytime on or before the maturity date of the loan, including before the end of the covered period, if the borrower has used all the loan proceeds for which the borrower is requesting forgiveness. So what that means is if you're using the 24-week covered period and in week 12 you've used up all your funds, you can now go and apply for forgiveness. The only catch though is if you, through the first 12 weeks, if you have any employees that you have not been paying at least 75% of their quarter one wages, then you have for a reduction, a salary and wage reduction for that. Well, it's not going to be just for the 12 weeks, it's going to be for the full 24 weeks, even though you're applying for the forgiveness after 12 weeks. So that's just something to keep in mind. And if what I'm talking about, you're not very familiar with it, and later on I'm going to get into the salary and hourly wage reduction, you'll see what that is, because to refresh, there's two ways that your forgiveness amount can be reduced. It's if you reduce your headcount or you reduce your salaries of employees during your covered period, which starts after you receive your loan proceeds. Here's an example of how this works. I'm not going to go through the example for the sake of time, but you'll have the slides to read through it. Okay, so as mentioned in the agenda, there's two forgiveness applications. There was originally just one, and then with the after the June 5th, they came out with a revised forgiveness application, and then they also came out with this EZ loan forgiveness application. You want to use this application if you can. It's a one-page calculation form, and then there's some additional pages with certifications, but it's going to be a lot simpler, and there's going to be not as many calculations that you have to do. So it's going to apply to borrowers that are self-employed and have no employees, or you're a borrower that did not reduce the salary or wages of your employees by more than 25% compared to Q1, and you did not reduce the number or hours of your employees. And it's not written on here, but it's actually from January 1st of 2020 to the end of your covered period, where you did not reduce the number or hours of your employees. And then thirdly, if you can't qualify for the first two, if you experience reductions in business activity as a result of health directives related to COVID-19, and you did not reduce the salary or wages of your employees by more than 25%, you would be able to use this form. And as mentioned before, this form requires fewer calculations. If you're familiar with the full-time equivalency reduction, it's one of the two reductions that can reduce how much your forgiveness you can receive. If you're using this form, you won't have to do the full-time equivalency reduction where you have to go back and look at prior periods, or if you're a seasonal employer, there's a third period you'd have to look at. You wouldn't have to go back and figure out what your FTEs are for those periods. You just don't have to do any of those calculations. It makes things a lot simpler. So the instructions here for this easy application, this is just regurgitating what I previously spoke about on the slide before, but it's in more detail. If you read up at the top, it says the borrower can apply for forgiveness using this form if you can check at least one of the 3 boxes below. You only have to check one of the 3 boxes below to be able to use the form. And then just to mention that paragraph that's circled at the bottom, this was something new that was part of the June 5th legislation that was passed, and where it says the borrower is unable to operate during the covered period at the same level as before February 15th due to COVID, and you have to you're abiding by the standards of sanitation, social distancing, and any other work-related requirement related to COVID-19. There have been a lot of questions of how do you support that or document that? On the next slide here, there's within the instructions, it says such documentation must include copies of applicable COVID requirements or guidance for each business location. So if you have multiple locations, you'd have to have any applicable COVID requirements for that location. And then if I don't think your lender is going to request this, but if the SBA was to pull your forgiveness application for audit, they could request your borrower's financial records. I think where they're getting at right there is they could see if your business level activity actually increased, where maybe your financials got better during the COVID-19 period. But I have an example I'm going to read through real quick. But I think general idea is if you had to shut down due to COVID because you're a non-essential business, it is likely you will be able to qualify for that paragraph, but you would still have to meet the requirement that you did not reduce anyone's salary by more than 25% over the covered period compared to Q1 of 2020. So here's this example. A PPP borrower is in the business of selling beauty products both online and at its physical store. During the covered period, the local government where the borrower store is located orders all non-essential businesses, including the borrower's business, to shut down their stores, based on part on COVID-19 guidance issued by the CDC. Because the borrower's business activity during the covered period was reduced compared to its activity before February 15th, due to COVID requirements, the borrower satisfies the Flexibilities Act's exemption and will not have its forgiveness amount reduced because of a reduction in FTEs during the covered period, as long as you maintain documentation. So the key here is the business was a non-essential business and it had to shut down. It is still possible if you were essential business that you could potentially qualify for that paragraph, but you'd have to look more into it. So this revised, this is the original loan application, but it's been revised a little bit. Nothing significantly changed. All the calculation mechanics are pretty much the same. But it does have that FT reduction safe harbor. That's what I was just talking about. What I was just talking about was on the easy form. But if you're not able to use the easy form and you have to use the long form, and when you're doing your FT calculation, if you do have where you're getting hit with an FT calculation, if you're able to qualify for that safe harbor I just talked about, it would be able to allow you to get out of that FT reduction. Then you wouldn't have your forgiveness amount reduced because your FTs were not as high during the covered period compared to the look back periods. Okay, I'm going to briefly recap some of the things that changed. I'm going to go through this pretty quickly. It's just an update here. Just to recap your covered period, when you receive your loan proceeds, it begins a 24-week covered period or 168-day covered period where you have time to spend your funds, or if you got the loan before June 5th, you can elect to continue to use the 8-week covered period. It's at your choice. But if you've got the loan after June 5th, you have to use the 24 weeks. And basically, as mentioned, it's just the time you have to spend your money. And if you don't spend your money during that time frame, then you'll have to pay money back. It won't be forgiven. And then the alternative covered period, payroll covered period, I'm going to skip over that. It'll be in the slides for you. So what costs are eligible for forgiveness? Here's the payroll costs. Nothing's changed about this too much, but down at the bottom, just keep in mind that for each individual employee, your cash compensation is limited to an annualization of $100,000. So if you're using the 24-week period, it's going to be $46,154. How that is derived is you're taking 24 weeks divided by 52 weeks, multiplying it by 100,000, and that's where you get that number from. If you're using the 8-week covered period, you get to count the first 15,385 per employee. That is derived by 8 weeks divided by 52 times 100,000. Just clear something up here. If you're using the 8 weeks and you paid an employee 20,000, you get to count the first 15,385. It's anything in excess of the 15,385 you do not get to count. There's this probably doesn't apply too much to not-for-profits, so I'm going to skip over, but if you are the owner of a company, there are limitations on how much the owner can count as eligible payroll costs for what they're paying themselves. So payroll costs, I talked about the cash compensation. Now I'm going to briefly talk. There's non-cash compensation. This didn't change much at all from the original legislation. You get to count your employee contributions for any employee health insurance, employee retirement plans that the employer is paying for, and then also employer paid state and local taxes on unemployment or on employee compensation, which would be like the Texas Workforce Commission. You're paying on the unemployment. These amounts are in addition to the cap that I discussed briefly. So just keep in mind the cap is not inclusive of these amounts. These amounts are in addition of the cap per employee. Okay, so payroll costs, when do they have to be paid? So they have to be paid or incurred during the covered period. Payroll costs are considered paid on the day the paychecks are distributed or the borrower originates an ACH transaction. Payroll costs are considered incurred on the day the employee's pay is earned. Just keep in mind, payroll costs incurred but not paid during the borrower's last pay period of the covered period are eligible for forgiveness if paid on or before the next regular payroll date. And I have an example of how that works. You have a loan, and I'm going to go through this example because there is working with clients. There's a lot of confusion on how this works, and it's good to understand it because it works to the borrower's benefit. So a loan was received on April 10th, and they're on an 8-week period. So the 56-day period ends on June 4th. They're paying their employees semi-monthly, one pay period in arrears. So if you look there on that first row, the wages incurred from March 16th through March 31st, these were incurred before the loan was received, but they were the wages were paid after the loan was received. So you get to count those because it's paid or incurred. And then if you go down towards the bottom, the May 16th through May 31st wages incurred, they were paid on June 15th, which is after your last day of your covered period. You still get to include them as long as they're paid by the next regular pay date. And then that last one, June 1st through June 4th, you get to include those 4 days in June because those are part of your covered period. And they're paid on June 30th, but you still get to include them. And as you can see, you get about 10.5 weeks of payroll costs using the 8-week covered period. So it's pretty important to know this. And then costs eligible for forgiveness, there are non-payroll costs. None of this changed. You get to count interest payments, rent, and then any utilities. I'm going to skip through that. And then the rules for when they have to be paid, it's the same. It's paid or incurred during the covered period. It works the same way as the payroll costs that I just discussed. So to big picture, how much the loan will be forgiven. This is going to be determined on how much of the loan was spent for payroll costs and non-payroll costs during your covered period. And as mentioned earlier, your non-payroll costs are capped at 40% of the forgiveness amount. So if you have payroll that's less than 60%, it's actually going to cap how much you can have forgiven. Just something to keep in mind. And then, most importantly, the forgiveness amount. You think, okay, I got my loan, I spent all the money within the covered period, I'm good, I'm gonna get it completely forgiven. Wait a second, you gotta watch out for these two reductions. There could be a reduction if you reduced your employees' wages during the covered period, or you reduce your employees' headcount during the covered period. And if you got an EIDL loan, that would reduce your forgiveness amount. And I'm gonna briefly go through these two reductions. So the first one's a salary and hourly wage reduction. What this is what you do is, or I'll read this. A reduction in forgiveness amount is required if the reduction in wages over the covered period is in excess of 25% of the total salary or wages of the employee during the period from January 1st, 2020 through March 31st, 2020. So this is Q1 2020. What this is saying is basically you're going to take your wages that you paid your employees during your covered period, and you're going to annualize it. Then you're going to go to the Q1 of 2020. You're going to take each, because you have to do this on an employee by employee basis. You're going to take that same employee and you're going to annualize the wages they made in Q1 of 2020. Then you're going to take the annualization of the covered period and Q1 and compare them. If your employee did not get paid at least 75%, have an annualized salary of at least 75% of what he made in Q1, then you have potentially a salary and hourly wage reduction. And the calculation's a little bit complicated. I have slides on how to calculate it, but I'm not going to go through it for the essence of time. And then one last thing on this, keep in mind, that you only have to test this on employees, any employees that made over $100,000 for any one single pay period in 2019, you do not have to do this test on. So if you had an employee in 2019 and you're paying people weekly, so there's 52 weeks in a year. If you paid someone in one pay period more than the $1,923, you do not have to do this test on them. So if in the covered period, if you paid them nothing or reduced their payroll significantly, that has no effect on your calculation. You would not get hit by a salary and hourly wage reduction. Okay, these are going to be a bunch of slides on how the calculation's done. And then lastly, here's the second one, the full-time equivalency reduction. This is the second one. Your forgiveness is reduced if your average number of full-time equivalent employees during the covered period is less than the average number of FTEs for any of the following periods at your election. So what you do here is you have to look at how many FTEs you had during your covered period, and then you have to look back to these periods. You choose the lesser of. If you had more employees in the covered period versus one of these look back periods, you're okay. But if you had less employees in your look back period if you had more employees in your look back period than you had over the covered period, you can have a FT reduction. But this stuff is really complicated. There are two safe harbors that could prevent the reduction from occurring. So I'll go through this example real quick. The business had 10 FTs during the 8-week covered period after it receives PPP loan proceeds. During the period February 15th, during one of the look back or both look back periods, you had 16 FTEs. So your FTEs during a covered period is 10 versus 16. You take 10 divided by 16. Your FTE quotient is 62.5. And that ends up leading you to having your total forgiveness amount reduced by 37.5%, which is bad. And here are the safe harbors. I don't have time to go through them. And lastly, this is the last slide I'll go through. When you submit your application for forgiveness, you have the lender has 60 days to issue a decision to you. And if the decision can be in the form of approval or denial, if there is a denial, you can ask the lender to reconsider. And then lastly, if you do not apply for forgiveness within 10 months after the last year recovery period, the loan is no longer deferred and you must begin paying principal and interest. That was action-packed. There's a lot of information in there. You'll have the slides. If you can go back and look through the examples in their prior webinars on that first slide that you can go and watch as well. That will give you more information and catch you up to speed on a lot of this stuff.
Thank you for joining us. To stay up to date on all of the webinars for the series, please make sure to follow our events page for more information. The link is in the description below, along with other important links, including our social media. If you want to see future Lane Gorman Trubitt Not-for-Profit Insights Webinar Series, subscribe and hit the bell icon for notifications.